Welcome back, everyone. Michael here with Offshore Citizen. Today we're going to talk about international investing. We're going to talk about should you invest overseas, how to find the best investments, is it a good idea to invest in abroad, why and why not, and hopefully dive into some of the considerations that you should take with respect to investing in general, but specifically the considerations that you may want to pay attention to as you invest anywhere. And I'm going to look at that from the perspective of if you're, say, American, if you're from some other countries, as you maybe change your residency, what effects that may have. So stick around and we're going to jump into that. Before we get started on that, if you haven't already, please hit the subscribe button, hit the notification bell, make sure you don't miss out on any of our videos. Try to produce great content for you every single day. And if you're at all interested in these subjects, we help with international tax planning, so how to pay the lowest legal amount of tax possible, designing structures for you, then helping to implement, setting them up with forming companies, opening bank accounts, etc., as well as getting residencies, citizenships, including unofficial citizenship programs, so very cool in that regard, and sometimes helping people with investing. So if you're interested in any of that stuff, reach out to me. You can book a call, clarity.fm/Michael Rosmer. There's a link below in the description. Or you can check out our websites, offshorecitizen.net and offshorecapitalist.com. All right, let's get into this. So I've been talking to clients quite a bit lately about investing and working on kind of some allocation of capital, etc. And there is, at the same time, kind of some information out there that I feel like is kind of harmful. And so I want to put it into context and kind of give you a sense of what you can expect in terms of investing abroad, in terms of investing locally, recognizing that where you're from could play a big role in this, and that you may not want to get in that situation, or you may want to get in that situation. So let's start with this, what I kind of think is sort of a myth that people sometimes have when they're leaving a country, when they're looking at possibly investing abroad, etc. And that is, there's within certain circles, and maybe it's part of marketing, this idea that, oh, hey, there's all these big returns abroad. And I hear this sense of like investing in, I don't know what you'd call it, banana republic. It's not really accurate. It's more like frontier markets, developing markets. And I think it's easy to believe, you can go and look at the bank interest rates that are paid in someplace like Egypt and say, wow, they're so high, right? Without considering the risk side of it. And in my experience, very often it doesn't actually make sense to invest abroad. So I like to think about this from a risk to reward standpoint, okay? Which is, if I'm going to go invest in an environment where I don't know the legal system, I maybe don't have the same recourse that I do in some other places, where it's less established in terms of the structure, etc., I better get compensated in a commensurate way for taking on that additional risk, okay? So let's use an example. Let's say that I was talking to somebody the other day and we were looking at investments in Georgia, okay? Now, there are perfectly good investments in Georgia for a number of years, especially there were bonds that were available that were fairly high interest compared to other areas. They were actual bonds that were traded, say, on the London Stock Exchange or similar, right? So nothing against those bonds by any stretch. However, we were looking at some deals where they were kind of debt loan based. And what I said is like, well, listen, it's undeniably more complex and riskier to invest in that environment than, let's say, what I can do in UK, right? So if I'm going to do that, I need to be compensated accordingly. And if you come and you tell me, hey, we're going to give you a loan product, or you're going to do a private loan based on some sort of a development or whatever, and it's going to pay 7 or 8%, how is that attractive, right? Because here's the thing, I can go and get 7 or 8% in the US, I can get 7 or 8% in UK, I can get 7 or 8% in Canada. Now, personally, I would never invest at 7 or 8% period. That's just a little bit too low for my tastes, because that's the upside. Then you have to measure it against what's your downside, and generally speaking, the downside is not a very good trade-off. You lack liquidity and things like this. So that being said, I think it's interesting to note that look, some people will kind of have this idea that they're going to get something for nothing, and they're looking at one side of it without seeing the other side of it. And they're introducing a lot of uncertainty into the equation, which might pay off, right? The reality is, if you go and invest in Cambodia or in Turkey or in Vietnam or any number of these other places, is it possible that you're going to get more upward pressure in the market due to the fact that it's developing rapidly and that you're going to make more money, that's possible, right? That is an entirely possible factor. But on the flip side, you are certainly entering into an environment where you have less direct levers that you can play with, and certainly less certainty about various different outcomes, right? Does that mean that it's necessarily better or worse? No, it doesn't. But there's a reason that some of the biggest money in, let's say, real estate, for instance, has been made in markets like New York, right? You might say, hey, listen, New York is oversaturated, there's lots of regulations, there's, low cap rates, there's et cetera, et cetera. All might be fair, right? But there's a reason why there's been major capital made there. So in this sense, I think that a lot of people who haven't experienced it tend to idealize some frontier and developing markets when they really shouldn't, right? This is maybe evident by the fact that the S&P 500 very consistently through broad periods will outperform developing market indexes, right? Even though on a GDP per capita or on like a GDP growth basis, maybe some of these developing markets are outperforming, okay? So you kind of need to be aware of some of these factors. Now, does this mean that you shouldn't go and invest in those markets or that you can't get as good returns? Absolutely not. But I think it's really, really important to be highly selective. So let's use an example. I was talking to a friend, a client, somebody who's a very good investor the other day, and we were just discussing opportunities and kind of the environment that has been created in places such as UK at the moment as relative to places like the US, right? And essentially, the difference in the financial markets has meant that there's an ability to provide gap financing at much higher loan rates with commensurate or better security than you can do in the US, simply due to the availability of capital and the regulations around what the loan to value that senior lenders are able to offer. So very, very interesting how that happens. And there's definitely opportunities to look abroad and say, hey, listen, are there some much better opportunities in another place than where I am? And kind of one of the ways that I characterize it or describe it is, listen, if you have only one way of approaching things, right? You have one tool in your tool belt, then because of the fact that we have different economic seasons, because there's different stages of the cycle, et cetera, you're going to run into trouble in a bunch of situations, right? So it's really, really useful to be able to expand your perspective and say, hey, listen, I'm in a position that I have the ability to go and to invest in other assets, to invest in other markets, et cetera, and do really well when another market is down. Being global is extremely beneficial as an asset, but I think that it's unwise to fantasize about far-off markets as opposed to domestic markets, because very often you're going to get better returns for lower risk in domestic markets, depending on what's domestic to you, okay? So that's just kind of like setting some context around kind of the myths, et cetera. Recently, looking at investments, the best return to risk reward, in fact, actually best pure return, and then combined with lower risk that I've seen on kind of like a lending basis has been in UK, in London, right? So you think, well, that's not traditionally a market that you would maybe say that you should expect high returns. This goes along with something else that I've seen sometimes from users on our channel, et cetera, is kind of some ideas about, hey, where can I get high bank interest or something? And what I've often told people is, hey, listen, typically that's a really bad way to go about it, okay? I'll give you an example from Canada as an example, okay? Traditionally, somebody might say, oh, hey, let me shop around for the best interest rate. Well, you were probably better off just to buy the bank's stock, right? If you think about it from that standpoint, generally the dividend was higher than an interest rate that you were going to get paid, and you had some upside available to you, which was not a normal thing. So that's something that might be useful for you to think about, okay? So that's one piece. Now, what I want to cover kind of is, who does this work for and who does it not work for? So let's start by talking about Americans. If we look at Americans, what we find is that the American legal financial system, or the tax system, I guess we would say, is designed kind of to keep money inside the US, okay? Somebody kind of labeled it for me fairly recently in this regard. But you have things like, for example, passive foreign investment companies. You have things like GILTI tax, et cetera, et cetera. And so for an American to invest abroad often actually has a detrimental effect from a tax standpoint as compared with investing domestically. So let's use some examples of this. Well, you have things like 1031 exchanges, right? You have things like your Roth IRA, your 401k, et cetera, various different mechanisms that are designed to allow you to defer the realization of gains to potentially perpetually, right? And to be able to amass this wealth and then access it in different ways or at the end. And a lot of those tools are greatly diminished when you start looking abroad. Okay, so as an American, I think to look abroad as places to invest, although it's a nice tool to have in your tool belt, it's often not very sensible, okay? And that's somewhat different from what you will get for people in a lot of other parts of the world. If you're in other parts of the world, it may make a lot more sense. And in fact, it may actually make sense for you to invest in the US, right? So some of the best investments that I see in various different categories of assets are US based, right? We can just kind of run down the list. Well, venture capital, all the big VC plays, not all of them, but a large percentage of them have come out of the US, right? So from an angel investor, VC type perspective, there's opportunities there. In terms of real estate, there's all kinds of opportunities that are on the real estate side. Now, it's more difficult to take advantage of leverage as a foreigner, et cetera, but there's really good deals that you can get on cash flowing property in certain states, buying at clear title, okay? So there's little, as well as, fix-ups, et cetera, there's a bunch of opportunities there. Loans, I haven't noticed as much of an opportunity in that regard, but certainly you can kind of look through across a variety of other categories in terms of like private equity, et cetera, potentially film finance, although I have noticed that in a few different areas as well. So you can see some good deals in Canada, et cetera. So, this may actually make sense for you as a foreigner. And in fact, there's some opportunities. For example, if you're a foreigner and you're able to lend into the US, you can take advantage of something called the portfolio interest exemption. So you can basically not be subject to withholding tax or tax on interest in general coming out of the US if you have the right structure. So that's something to be aware of. On the flip side, if you are, say from UK or somewhere else, it make a lot of sense for you to invest in Czech Republic. It may make a lot of sense for you to invest in Vietnam, right? It just depends on what the stages are in the market and what the structure is that you take to go and invest there, as well as, of course, looking on a deal-by-deal basis. And I guess that's kind of the main thing that I think of. I think of, okay, like what is the stages of the market that you're at? What is the structure that you're able to employ in order to optimize your tax and kind of increase the efficiency of the investment from that standpoint? And what is the deal that you can negotiate? And if it turns out that, hey, listen, you can get the right partners, you can get the right location, you can get the right structure, you can negotiate the right deal, then great, by all means, go for it. The last thing that I would mention is even when you don't have necessarily a risk to reward advantage in kind of like a pure return basis, right? Meaning that, hey, maybe my returns won't be higher. I do think that there's some value in investing abroad for two other reasons. One is you can sometimes get a fringe benefit such as a residency or a citizenship, right? So let's look, for example, at Turkey, right? I don't especially think that Turkey is an amazing place to invest right now. Again, deal by deal, you can kind of take a look at it. However, there's a lot of risk associated with investing in Turkey due to uncertainty with the lira, geopolitically, et cetera, right? However, if I sit down and I say, okay, well, I'm going to invest, in some property, and I'm going to allocate $300,000 anyway. If I can go and find some good cash flowing deals in Turkey, or maybe I can find a property that, hey, I'm happy to have it as a vacation home or something like that, and I can also get a citizenship for me and my family, well, that's kind of like a risk mitigator, right? So I have that added benefit there, which I think is worth considering. The other thing that I think is worth considering in that overall picture is kind of the asset protection, not all your eggs in one basket perspective, right? Which is to say, hey, listen, what if something happens where you are, right? Do you want to be very concentrated? It's okay to be. There's certain advantages, obviously, in knowing that market. But on the flip side, if you're in a situation where you say, okay, great, I can go and I can make some investments abroad, and it's more or less an equivalent investment. Maybe it's not slightly better, maybe it's even slightly worse. But if anything ever goes wrong, I have another option. And I'm taking an option out in the sense that I don't know which of these markets is going to do well. So, if this one does well, great. If this one does well, great. Either one, I'm winning. So anyway, I hope that kind of gives some context, some help. If you have questions about any of this, please reach out to me. Again, you can book a call at guardia.fm/Michael Rosmer. We can have a conversation about, what's the structure, where you might want to go, what kind of current trends there are, what the tax consequences might be, etc. Again, if you haven't, or you can also reach out, of course, on our websites. Again, offshorecitizen.net, offshorecapitalist.com. And if you like the video, please give it a thumbs up. If you have questions, please put them in the comments below. If you have something you'd like to see me create, do that. And if you have some feedback to improve, please put it in the comments as well. I will see you guys on the next video.